Hello everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 5. This lecture is in continuation with lecture number 4, okay, in which we were covering chapter number 2, unit number 1 of CA Final Financial Reporting. We were discussing all about Ind AS 1, the presentation of financial statements. Till now we have covered some topics and lastly we covered 3 examples. Okay, now we will continue and see the 4th example and further on some remaining topics of Ind AS 1. In case of any doubt, you can definitely reach out to us via the comment box, or you can definitely download the app and chat with me in person. Okay, let's begin. Example number 4. In 2008, entity Superb was acquired by entity Happy Go Luck. To align its reporting date with that of its parent, Superb changed the end of its annual reporting period from 31st January to 31st March. Now, consequently, instead of preparing 12 months financial statement, it has elongated. It has now longer reporting period of 14 months. Okay, got it? So, in case if you have shorter or longer reporting period, what do you need to do? You need to disclose 2 important things. Those were what? Firstly, the reason behind shorter or longer period, reporting period, and secondly, what was it? Secondly, the fact that such previous figures are not comparable with the current figures, okay, because previous figures were of 12 months and now it is of 14 months, okay. You have to mention and disclose these 2 particular things. On the basis of these facts, the following disclosure would be appropriate. Extract from the notes to entity Superb 31st March 2008 financial statement. What is it? Note needs to be presented, disclosure needs to be made. Basis of preparation and accounting policy. What do you need to do? To align the entity's reporting period with that of its parent Happy Go Luck, the entity changed the end of its reporting period from 31st January to 31st March. This is what? This is basically the reason. First thing you have to do, put the reason. Amounts presented for the period ended 31st March 2008 are of 14 months. Now, secondly, what you have to present? You have to state the fact that the comparatives are not comparable. The comparative figures are for 12 months period. Consequently, comparative amounts for the statement of comprehensive income, statement of change in equity and statement of cash flow and related notes are not entirely comparable. Okay, I said that you have to mention 2 things. Firstly, the reason, and secondly, that the fact these are not comparable when you are adopting any shorter or longer reporting period. So, from this example, you are more accommodated with the concept that in case of any longer or shorter reporting period, what you need to do. Now, next comes additional comparative information. An entity may present comparative information in addition to a minimum comparative financial information. I told you that additional financial reporting statements are generally needed when the accounting policies are changed retrospectively. Then you need to present additional balance sheet, P&L and all. When? How? You have to present the opening figures of the earliest period that you are presenting in the financial statement. For example, current year, previous year, then you have to also provide opening figures of previous year. Example 5 is given. An entity may present third statement of profit and loss. Okay, third statement means that additional opening figures of the earliest period, thereby presenting the current period, the preceding period and one additional comparative period. However, the entity is not required to present third balance sheet, statement of P&L, statement of change in equity. Okay, the entity is required to present in the notes to financial statement that the comparative information related to the additional statement of P&L and other comprehensive income. They need to present this the same in the notes to account that comparative figures are presented on the financial statements. Next example, example number 6. A significant acquisition or disposal or a review of the presentation of the financial statements might suggest that the financial statements need to be presented differently. An entity changes the presentation of its financial statements only if changed presentation provides information that is reliable and more relevant. Okay, the presentation is changed only and only when it provides 2 things: when it is permitted by Ind AS, and secondly, either it is providing reliable and more relevant information. Okay, the same lines you will read in Ind AS 8 as well. Okay, these lines are from Ind AS 8. Okay, which talks about accounting policies, estimates and all. So the accounting policy can be changed, the presentation of financial statements can be changed only and only in two cases: when the Ind AS itself permits, and secondly, they are providing more reliable and more relevant information. User of the financial statement and the revised structure is likely to continue, so that comparability is not impaired. It should not be that you are changing the policy just for 1 year. Anytime you are changing it, then it should be applicable to further subsequent years, so that the information is in a structure that is comparable, that is uniform, that is consistently applied. When making such changes in presentation, an entity reclassifies its comparative information. Okay. Example number 7. Financial institutions would amend the description of line items to provide information that is relevant to the operations of financial institutions. What does it say? For example, any financial institution like NBFC is adopting Ind AS, then they have to apply Ind AS according to their own line items. They have to describe, they can amend the description of each line item according to the Ind AS to better provide the description and the presentation. Okay, if they are able to provide more reliable and more relevant information, they are allowed to amend the description lines of the financial statement. Okay. Now, structure and content of balance sheet. Firstly, if we talk about P&L, there the structure was given that income and expense statement has two parts: P&L and other comprehensive income, OCI. This together was known as total comprehensive income. We had 9 items that had to be presented under OCI. Other than that, all the others will be given effect in P&L portion. Okay, you have to learn that 9 items in case if you are attempting ICA exams. Now, if we talk about asset, always assets will come first and then liabilities or equity will come. Okay, if we talk about asset, firstly non-current asset will come and then current asset total will be given. And then if we talk about equity and liability, see, equity is a broader term, whereas equity shares are smaller term. Equity comprises of equity shares plus reserve and surplus. Okay, so equity is a broader term which has equity shares, preference shares and all, plus retained earnings, or you can say reserve and surplus, whereas equity shares is a part of equity. Okay, so don't confuse. Whenever it is written equity and liability, equity includes equity, shares and all, plus reserves and surplus, or you can say retained earnings. Then after that, non-current liability and then current liability. Okay. Now comes current versus non-current. This is very important, very important, even from the view of practical knowledge about the balance sheet and P&L, and also from the purpose of solving the questions. Okay, current versus non-current. Generally, we used to consider that as per accounting standard and all, that any asset, for example, will be encashed within next 12 months, then this is current asset. If it will be encashed after 12 months, if the benefit will be encashed after 12 months, then that portion will be non-current. Okay, are you clear? But now, as per Ind AS, the scope has been widened and it lays down that if any of the following condition is satisfied, then asset is current asset. Condition is what? If item is cash and cash equivalent, you have to learn this, because while writing answer, this will be needed. Okay, you have to write down the answer in this way: item of cash or cash equivalent. Second, items held for trading, anything that you have kept for trading purpose will be considered as current. Thirdly, realized within 12 months. Okay, this was the same condition laid down in accounting standard as well. Okay, nothing new. Fourth, and this is important and very new, that realized in operating cycle. If anything is realized in operating cycle, for example, operating cycle is of 13 months. Please listen carefully. For example, if the operating cycle is of 13 months, if anything that is realized that will be encashed in 13 months, then it will be considered as current asset. Okay, if we talk about accounting standard, what we used to do, up to 12 months it was current, and above 12 months was always considered as non-current. Okay, here if we talk about operating cycle, if operating cycle is given, then okay, you calculate it. If it is not given, then you assume 12 months. If anything that is encashed or will be paid in 12 months in the operating cycle, then this will be termed as current. Other than these 4 items, all things will be considered as non-current. Either it is cash or cash equivalent. Secondly, held for trading. Thirdly, 12 months realized in 12 months. And fourthly, it is realized in operating cycle. Okay. Non-current asset other than current asset. An entity is permitted to present some of its assets and liabilities using current and non-current classification, and others in order of liquidity. They are permitted that they can identify different class of items and assets, and they can value them on different basis. Okay, they are allowed that different class of asset can be classified and then can be valued at different basis. How? For example, if you have 2 buildings, if the nature is same, okay, if the nature is same, the purpose is same, the amount is same, purpose and nature is same, then what you need to do, you have to classify and apply only one sort of method. Okay, but if you talk about, you have building, one is for investment purpose, one is for business purpose, or you can say the different intentions are there, different purpose are there, anything, the nature is different, then you can apply different valuation style. Okay, it is permitted to present some of its asset and liability using current and non-current, other can be shown at the liquidity basis, order basis. The need for mixed basis of presentation might arise when entity has, it is particularly when diversified operations are there, because for a particular operation, some particular thing can be current, and for other it can be non-current. The different operations might have different operating cycles. For example, if we talk about wood, it is of 12 months. If we talk about aeroplane, it is of 3 years. It can be this way. Okay, so if we talk about operating cycles can be different, it can vary, and therefore current and non-current classification, the order liquidity classification, current non-current classification can be done in different way by one particular entity if it has diversified operations. Okay, are you clear? Let me know. In case of doubt, please let me know. Don't keep your doubts as doubt with you. Okay, please put it out, please let me know, and I'll get you the answers as soon as possible. Okay, next, liability. Same way, if any of the following condition is satisfied, then it will be known as current liability. Other than that, it will be considered as non-current. Items held for trading, settled within 12 months, settled in normal operating cycle. If it is, for example, normal operating cycle is 15 months. If a particular thing is paid within 15 months, then it will be considered as current, even though it is exceeding 12 months. At balance sheet date, entity has no unconditional right. It has no opportunity, no unconditional right to defer payment or avoid such payment beyond 12 months. If such condition is there, that they have to pay within 12 months, they cannot avoid it, they have no such right to avoid it, then it will be known as current liability. Other than that, it will be known as non-current liability. You will get the picture more clear when you will be solving the questions of ICAI. That we'll do in the next class definitely. Okay, solving questions is very helpful for a student. Basically, yes, true yes. And if we talk about a professional who has done their accounting, their CA course from old course, and they are very new to the Ind AS, they should learn and they should once go through the examples as well. Okay, because it is very important. The examples tell you how to apply a particular provision. They give you a better clarity and understanding. Okay, so even if you are professional, don't consider that, oh, how can I learn like a student? What is this? Why should I learn these examples? Don't learn them, but you need to go through them once at least. And if you are a student, you have to learn them, revise them, and revise it as much as possible. Okay, even there is a test after every 3 chapters. Okay, you can apply that, you can download the app and attempt the test. Okay, I evaluate each and every test personally and give marks, and personally talk to each person who is attending the test. Next, if you are a professional, you can, and if you are not planning for any sort of exams, you can avoid giving test and all. Okay, what is operating cycle? Operating cycle is basically inventory period plus debtor collection period. This means, for example, if you talk about raw material, you purchased raw material, it was lying for 2 months. Okay, now the WIP process is of 3 months, then finished goods are lying for 4 months, example, and then after selling them, okay, after selling them, the debtors are realized in, for example, 7 months. Calculate this, 5 plus this 4, 9, 16. 16 month is your operating period, operating cycle. How come? That from the start, from the where you extract or you procure or you purchase the raw material till the time it is encashed from the debtors, this is known as operating cycle. Okay, this is your inventory holding period. Inventory holding period is 9 months plus debtor collection period is 7 months. As soon as you total this, there comes a amount 16 months, and this figure is known as debtor collection period, operating cycle. Operating cycle of an entity is the time between the acquisition of the asset for processing, that is raw material, and their realization in cash and cash equivalent. Current assets include assets that sold, consumed or realized as a part of the normal operating cycle, even when they are not expected to be realized within 12 months after the reporting period. There are some assets that are sold, consumed or realized as a part of normal operating cycle. They will always be considered as current, even though they are not realized within operating cycle or within normal 12 months. Okay, if operating cycle is given, you will calculate it. If it is not given, it will be assumed 12 months. Operating cycle varies and differs from entity to entity, operation to operation. Okay, as I told you that wood takes, for example, 12 months, but whereas aeroplane takes 3 years. Okay, so there is operating cycle difference. Let's study the example number 8. You will get a better picture. Please stay with me. Please watch the video till end. An entity produces whiskey from barley, water and yeast in a 24-month distillation process. Okay, the WIP process is what? 24 months. That is 2 years. At the end of the reporting period, the entity has 1 month supply of barley and yeast, raw materials, 800 barrels of partly distilled, that is, this is raw material. Okay, 1 month supply of barley and yeast is raw material, 800 barrels of partly distilled, this means WIP, and 200 barrels of distilled whiskey, that is finished goods. So you have raw material plus WIP plus finished goods. Okay, so these you have as an asset. Now you should classify this as current or non-current. So the operating cycle is, what is your operating cycle? Operating cycle is 24 months, because the normal process of converting the raw material to the finished products and to get the encashment is what? 24 months. Further, there is no debtor collection period given for time being. All the raw material, that is barley, WIP, that is partly distilled whiskey, and finished goods, that is distilled whiskey, are inventories. Okay, now the raw materials are expected to be realized, that is turned into cash after being processed into whiskey in the entity's normal operating cycle. If normal operating cycle something can be encashed, then it will always be termed as current asset. Therefore, even though the realization is expected to take place more than 12 months after the end of the reporting period, the raw material, work in progress and finished goods are current asset. Let me know in case of doubt. Okay, current asset if they are being realized within operating cycle. Your operating cycle is of 24 months. Next example, an entity owns a machine with which it manufactures goods for sale. It also owns the building in which it carries out its commercial activities. Okay, this is what manufactures for sale. So machine and building, there are two assets. These all are non-current assets because they are neither cash and cash equivalent. They are not expected to be realized in normal operating cycle. They are not held for trading purpose. Okay, and therefore they are not expected to be realized within 12 months of the end of the reporting period. So therefore these machine and the building both are non-current asset. Next, example number 10. On 31st December 2002, an entity replaced a machine in its production line. The replaced machine was sold to a competitor for 3 lakh rupees. It was sold for 3 lakh rupees. Payment is due in 15 months. Okay, payment is due in 15 months after the end of reporting period. So it will be encashed in 15 months. Okay, so since here the operating cycle is not given, you will assume it as 12 months assumed. So if you are realizing a particular payment after 12 months after operating period, then this will be considered as non-current. Okay, the receivable is non-current asset because it is not a cash and cash equivalent. It will not be realized or consumed in entity's normal operating cycle, not held for trading, will not be realized within 12 months from the end of the reporting period. For example, if the payment was due in less than 12 months, then it would be considered as current asset. Are you clear? Are you clear that as per Ind AS, when you need to classify under the head current and when do you need to classify under the head non-current? It all depends on an additional point, that is operating cycle. Other points are same. The additional point is your operating cycle. Operating cycle is mathematically the inventory holding period plus the data collection period. It simply tells that from the extraction or purchase of the raw material, initial purchase, to the final realization into cash, final conversion into cash, the time period that you are taking is known as operating cycle. Okay. Example number 11. On 1st April 2002, XYZ invested rupees 15 lakhs surplus funds in corporate bonds that bear interest at 8% per year. Interest is payable on the corporate bonds on 1st April of each year. The principal is repayable in 3 annual installments of rupees 5 lakhs starting from April 1. Okay, so if we talk about that, the amount is 15 lakh. Within 12 months, what you have to pay? You have to pay rupees 5 lakh. And after 12 months, what you have to do? You have to pay these 10 lakh. Okay, so this remaining will be known as non-current. But this 5 lakh that you have to pay within next 12 months will be termed as current. See, read this. In its statement of financial position 31st March 2003, the entity must present the rupees 1,20,000, that is interest amount, plus the 5 lakh as current portion of the non-current loan, that is portion repayable on 31st March 2003 as current asset. Okay, this portion plus interest should be considered as current. They are expected to be realized within 12 months of the end of the reporting period. The installment of rupees 10 lakh due later than 12 months after the end of reporting period is presented as non-current because it is not cash, and that same definition is written. It is neither cash or cash equivalent, not expected to be realized or consumed within normal operating cycle. It is not held for purpose of trading, and it is not expected to be realized within 12 months. Next example. Gains realized on disposal of financial asset are included in profit and loss of the current period. These amounts may have been recognized in other comprehensive income as unrealized gains in current or previous periods. Those unrealized gains must be deducted from comprehensive income in the period in which the realized gains are reclassified to P&L. See, I have told you that you have PL, OCI, which together becomes TCI. Okay, so if something was already added to OCI, then you need to remove that from OCI and then add or adjust into P&L. Okay, see what it is written. If something was already included in P&L, okay, but it may have been recognized in OCI. such unrealized gain, then what you need to do? Those unrealized gain must be deducted from OCI, must be charged to OCI, and then should be reclassified to P&L to avoid including the item in the total comprehensive twice. If it is not removed from one and then also added to the second portion, then in TCI it will be twice. So in order to avoid twice calculation, twice inclusion of the same thing, you need to remove from one and then adjust in the second portion. Okay, it might differ or dependent on the transaction, the nature of transaction, or what prior transaction or treatment you have done. Okay, but you do not need to record any of the transaction twice, or double counting is not allowed. Okay. Example number 13. The group includes within net debt interest bearing loans and borrowings, trade and other payables less cash and cash equivalents excluding discontinued operation. Breaches means breaking of any laid down condition. Okay, not following any laid down condition. Breach is in meeting the financial covenants would permit the bank to immediately call loans and borrowings. Okay, for example, there is a non-current loan. Okay, and there are conditions attached to it. If in case you do any sort of default, okay, if in case you breach any sort of condition, then what happens? The banks are entitled to ask and to call for the loan amounts as and when you have breached or defaulted. Okay, since now you have to pay such amount in next 12 months, you have to reclassify it as current. Okay, in case of any default or breach. Example number 14. This is simple allocation of capital allocation policy, that how much you have to present it, allocate to debt portion, how much to equity, what should be the source, how should be it allocated. Okay, the decisions related to this are known as capital allocation policy. For example, an example is given that board of directors reviewed and approved a revised capital allocation policy of the company. The key aspects of the capital allocation policy are that company's current policy is to pay dividends up to 50% of post-tax profits of the financial year effective from financial year 2001. The company expects to pay up to 70% of the free cash flow. Okay, this is simple. How much dividend to be paid, what source of money should be said, whether we should take any loan, debentures, deposits, equity, preference. Okay, these all are capital allocation policy. How much dividend should you pay, which year you should pay. Okay, what will be the tax liabilities related to it. This all planning is known as capital allocation policy. The board has identified an amount of rupees 13,000 crore to be paid out of shareholders during financial year 2001 in such manner, including by way of dividend or share buyback, to be decided by the board. Free cash flow is defined as net cash provided by operating activities less capital expenditure. The amount that is provided by the operating activities minus the capital expenditure, okay, as per the consolidated statement of cash flows prepared under Ind AS. This is simple capital allocation example. You just need to read it once. Next, special treatment of some points are given. These are also ICI questions. Okay. See, if we talk about electricity deposit, what is electricity deposit? For example, whenever you take electricity connection, you need to deposit some amount as security deposit. This will be refunded to you when you take a electricity connection cut. Okay, if you deregister from the electricity connection, then only you will get such refund. Okay, other than that you will not get such refund. First point. Secondly, you always assume that there is a going concern in next future upcoming period. You will not be closing your business, neither any necessity nor any intentions to close down the business. Okay, so going concern assumption is there. Since going concern assumption is there, that means you are not seeing that in future you will, in upcoming 12 months or upcoming years, you will be disconnecting the electricity connection. That means you will not be getting the electricity deposit refund. Therefore, these are known as non-current asset. Why? Because they won't be encashed in the normal operating cycle. Next, tender deposit, if they are recoverable within 12 months, then classify as current. Not recoverable within 12 months or operating cycle, then non-current. GST paid under dispute, if you have paid something, if you are in a position to expect that such a particular deposit amount, a disputed amount, will be paid or will be settled within 12 months, then classify as current. If you expect that it will be settled after 12 months, then classify it as non-current. For example, loan liability, repayment of due in next 12 months. If you talk about 15 lakh was there, what did you do? There was 5 lakh, the current year was classified as current. The current portion was, the amount that was due in 12 months was classified as current, and the amount 10 lakh is classified as non-current. Okay, so it is saying that the same amount of loan, the portion that is due in next 12 months should be classified as current, then after 12 months should be classified as non-current. If loan is repayable in installments, then installment due in 12 months should be classified as current, and the remaining should be classified as non-current, balance portion. Okay. Now, in case of repayment of loan through bank transfer scheme, if transferred from different bank, if classification of old loan continues, for example, what happens is that, for example, if you've taken loan from HDFC Bank and now you want another loan from PNB Bank, okay, it happens. So, if your previous bank asks you to repay all the amount and then only you can take a new loan. So, since the repayment is due immediately, and therefore such repayment amount, the amount is known as current amount. Okay. Now, if we talk about a bank that is rolling off your loan, okay, it is rolling off your loan, and how come they are saying that some other condition and some add-on top-up is given to you, and your loan period has been extended to further 2 years, for example. So, since the loan has been extended, the scheme has been changed, but it is not demanding any sort of immediate payment. If a particular bank is not demanding any sort of immediate payment, therefore it will be continued to consider as non-current. If it asks for immediate payment, if it demands for immediate payment, then what you need to do? You have to classify it as current. Are you clear? Case 1, if you transfer from different bank, then classification of old loan continues. New loan shall be classified as per new terms. If you transfer within same bank, then you have to see that the agreement has been finalized before the balance sheet date. Then classify the old loan shall be as per the new loan. If it has been finalized before the balance sheet date, then classify as per the new loan. If not finalized, then continue the old loan classification. There is a potential of refinance. There is a potential that you will be taking a refinance, but since the conditions has not been finalized, then such potential does not amount to any classification or reclassification. Okay, the classification of old loan continues. The potential of refinance is not at all relevant for any sort of reclassification in case of current or non-current. Last comes is CARF. There is a simple one CARF, that is International Accounting Standard 1, says that if there is any loan, okay, and that is classified as non-current, okay, no issue. If in case there is any breach, or default, the bank has power to demand or call the loan amount as and when, okay, immediately. The loan amount becomes payable immediately, and therefore it should be classified as or you can say reclassify as current. Okay, this is same in both International Accounting Standard 1 and Indian Accounting Standard 1. Okay, this is same. Till now there is no difference. But if such breach such breach is corrected, okay, if such breach is corrected, okay, then International Accounting Standard says, then also, see, International Accounting Standard says then also continue to classify it as current. Okay, in IAS says. Whereas Indian accounting standard says that if a particular entity has rectified the breach, has corrected the breach, has corrected the default, and the bank is not in a position to call the loan, then as per Ind AS you can reclassify it as non-current. Okay, this is said by Ind AS. See, read it once. In case of non-current loan liability, if any material provision of the loan agreement is breached at balance sheet date, then such loan shall be classified as current liability. Okay, shall be classified as current liability. Even if the breach is rectified after balance sheet date, you have to continue to classify it as current. Okay, but Ind AS says that in case of non-current loan liability, if any material provision of the loan agreement is breached at balance sheet date, then such loan liability shall be classified as current liability. But if the breach is rectified after the balance sheet date but before approval from the board of directors of the financial statement, then the banks cannot demand such loan amount payment as a consequence of the breach. Such loan will be classified as non-current liability again. Are you clear about the carve? This is given a relaxation in India because the breach is quite frequent. Whereas if we talk about foreign countries, the IAS has not given any sort of relaxation for the defaulters. Their rules are strict. Okay, so in order to make it more accommodate in the India, in our country, therefore such change has been brought out, such convergence. While doing such convergence, such provision has been put up. Okay, that's all about Ind AS 1. We'll discuss the ICAI question and answers in the next class. Okay, till then, in case of any doubt, please reach out to us, download the app and see all the free videos and the PDF notes that are available. See you in the next courses. Till then, take care, be safe, stay tuned.